This is a test of the City of Palatka audio system.
Call the meeting to order at 10:04. We'll do a roll call.
Here.
Alex Romero,
Here.
Kevin Sutton,
Here.
Art Leary called in today. He's going to be absent, and Chad called in yesterday. He's absent, and we do have a quorum.
All right. Has everyone reviewed the minutes from our last meeting?
I make motion.
I second that motion. All right, so we're good. All right. Good morning. On to Capital City with Mr. Madron.
Okay, good morning. Can everybody hear me? Dwayne Madron, Capital City Trust Company, Tallahassee. And in front of you, you have a report that looks like this with a blue stripe on it. And so I'll make some comments on the first page in, which says policy review, is a snapshot of the fund as of August 14th. There are ranges that I am supposed to stay within, and all of the investment percentages of total market value are within the range of the policy. You can see where large cap equities is a little bit below 40%. About a month ago, I trimmed equities back 3% because equities were getting expensive, and it was the total fund was bumping its head on the cap.
Mr. Chair, I do apologize. Does he have his microphone on? I'm not seeing any captions on my end.
Hold on. Okay. Hello. Can you hear me? Is that better?
Is the light on your microphone?
Yes, the blue
And
light
it's
is
on.
on.
Thank you.
Okay, I'll back up a little bit. Dwayne Madron, Capital City Trust Company, Tallahassee. We're going over the policy review on the first page of the report. And I was saying that I trimmed equity about a month ago, back 3%, because the total fund was bumping its head on the policy cap for equities, which I believe is 75%. It currently is 70. So in addition to that, international is a little bit underweight at the expense of being overweight in U.S. equities, which is what we prefer. We have a home country bias and believe that there's plenty of great opportunities in the U.S. and you don't need to load up on international. So we're usually underweight international unless the dollar is weak or economic growth in other countries is strong. Small cap is a little bit underweight the policy percentage because small cap has lower quality companies in it. And during tough economic times, small companies don't do as well as large companies. So that's why small cap is underweight just a bit. Mid cap is a sweet spot in the stock market where companies are starting to get up on their own 2 feet and run, like FedEx is an example. And so that's equal weight. Private real estate is pretty much equal weight. Infrastructure is pretty much equal weight. Convertible bonds are equal weight. And bonds are starting to be a little bit overweight because they're inexpensive and the yields are attractive. So when I did trim equities, I gave the money to Sawgrass so they could put it into bonds. So that's why you see bonds a little bit higher than the policy percentage. And then high yield bonds, because they tend to behave like equities, are equal weight. And also because rates may drop, which would help high yield bonds. Any questions on the policy review? By the way, cash is paying 5.1%. You can see where we're holding 6% in cash. That's sort of high, but I don't mind holding cash when it's yielding that high. It's yielding almost as much as a bond. So having said that, if we turn to account performance, 2 pages over, there's a green pie chart, page 4. We can look at the latest quarter ending June 30. Total fund return 1.62, equity return 1.72. That includes convertible bonds in that equity number. It was a quarter that was sort of indicative of technology stocks doing quite well due to artificial intelligence helping earnings growth. In addition, economic growth was a little bit better than people expected, and consumer spending was strong, although some of the consumer spending is coming from credit card debt, which is becoming somewhat of a concern as it goes up and delinquencies start to rise, but it hasn't been a disaster yet. So the consumer, which drives 2/3 of our economy, is still strong. And they're spending, and as long as they're spending, the economy does well. Unemployment is reasonable. It isn't too high, it isn't too low. It's about where the Fed wants it. So it's almost at full employment, and so that's a good thing. Year to date, fiscal year to date, the fund is up 21%, which is outstanding. Equity part fiscal year to date is up 23.4. Bonds, which are high yield bonds, are up 9.6, and cash is up 2.9. So we bounced back a lot from what we lost in 2022. And so that's good. Each of the last 3 years, the fund returned 4%. Each of the last 5 years, 10.3 per year, and since inception, 5.93. So that's the equity portion that I manage. That doesn't include Sawgrass. So having said that, are there any questions? If not, just for information purposes, on page 5, I included the July returns. You can see the latest quarter jumped quite a bit from 1.62 to 8.38. July was a good month, and August is going to be a decent month, I think. So we turn over to the asset allocation on page 7. There's 2 separate pages. I won't go over a lot of it because it's sort of informational, but the equity part that we manage is 77% equities. Bonds are 13.9, which is the high yield, and cash is 8, but that is not the total fund. The total fund has approximately 70% equity if you count the real estate and the infrastructure and the convertible bonds. And if you see page 8, you can see the funds that we use are very straightforward, cost-effective index funds for the most part. And most of it is in the Vanguard, the company Vanguard index fund, which is the S&P 500 index. There is an active manager, American Funds, Euro Pacific Growth. The rest of the equities are passive. In other words, they're indexed. You turn over to page 9, you'll see the convertible bond fund, which is an index fund, and the high yield bond fund, which is also an index fund. So the fees are low. It's a very cost-effective way to get diversification. Page 10 is a snapshot of the Sawgrass account, which is valued at $2,294,000. So we're the custodian on the securities. So that's why I'm giving you this information. So the money is housed at our trust custodian, which is Reliance. Any questions? That concludes my comments. It's been good. We coming back strong from what we lost in 22.
Motion to accept the report.
I second the motion.
Motion passed unanimously. We'll go to next up, Burgess Chambers.
Right, good morning. Thank you for having me. Obviously, I'm not Burgess. I'm Mitchell Brennan here for him today. You should see a handout that I'll go over first. So it looks like this on the front. We'll start on page 1 of that. Just an update on markets. Obviously, a lot has happened since the end of the quarter, June 30th. So I want to give a brief update on that, and then we'll jump into the full report. So on page 2, you'll see here on the left-hand side, the Magnificent Seven. So really a continuation of last year where the 7 large cap growth, tech, communications companies, so think of NVIDIA, Meta, which is Facebook's parent company, Microsoft, Amazon, Apple, Google, Tesla. Those 7 companies have continued to lead the markets higher. And so you'll see on the left-hand chart, this is actually through the end of July. And through June, significant outperformance compared to the market. On average through the end of July, 29% return for those 7 companies, attributing over half of the total return of the index. If you look at the other 493 companies in the S&P 500, on average up just 7% year to date. Now you'll see the sharp decline on that green line. So in July, we actually saw a reversal where a lot of those large cap tech names, especially NVIDIA, sold off. And we saw a broader market rally where things like small cap was up over 10% for the month of July. Mid cap outperformed up 6%. Large cap value, so areas like financials, real estate, they started to outperform on the expectation that we are going to start seeing rates come down, and that should benefit those companies. And so certainly something healthier that we like to see, a broader market doing well, not just a handful of companies leading things higher. The next page, page 3, just highlights that even further. So you'll see this is through the end of last week. And so the Russell 2000, our gauge for small cap on a quarter-to-date basis, so July 1 through Friday, up 8.5%. The Russell 1000 value, so large cap value, up 6.5%. Compare that to the gray highlight right between them, large cap growth up just 1% quarter to date. And if you look all the way to the right, that 3-year column, these are areas of the market that either haven't participated or have really underperformed large cap and large cap growth as a whole. So if you look at the Russell 2000, it was actually at the end of the second quarter, it was negative for the past 3 years. The recent rally has put it back in positive territory, but on a 3-year basis, up just shy of 5% annually. Compare that just below to the Russell 1000 growth, so large cap growth, up annually over the past 3 years, over 32%. And then large cap value right below that, highlighted in the red box. On an absolute basis, 22.5% is fantastic, but again, that trailed large cap growth annually by nearly 10%. So again, certainly would love to see a broader rally like we've started to see in the second quarter. And obviously, as rates start to come down, those areas that haven't participated should benefit to the upside. On page 4, speaking of interest rates, the one thing that has really been the focus of the Fed and their attempts to eventually start lowering rates has been inflation. So this is a chart going back to early 2021, shows the trend of inflation peaking in June of 22 at over 9%, coming down in June of 23, all the way back down to 3%. And then really over the past year, we kind of bounced between 3 and 4%. We finally broke through that 3% threshold in July. The CPI number is not shown here. This is through June of 24, but in July, we just got that reading a few weeks ago, 2.9%. So now with that, the most recent Fed meeting last week, Jerome Powell has indicated that we are going to start seeing rate cuts this year. There's essentially as close to 100% probability that we'll see at least a 0.25% rate cut in September. And now the expectations for market are we going to see just 1/4% rate cut? Will we see 50 basis points, so 0.5% rate cut before the end of the year? And so the money is at least 1/4% rate cut in September, maybe an additional one in December. And then if we see jobs numbers, labor market numbers really start to tank, we could see the Fed more aggressive and cut rates at a faster clip. But our expectation right now is begin with a 0.25% rate cut and then reassess in December and could potentially see another 0.25% rate cut during that time. And that's shown on page 5. Those dotted lines on the far right are the expectations of the Fed in blue and the market in green. So the Fed is content with just 1 rate cut for the year. The market expects 2. And then if you look into 2025, the Fed is expecting 4 rate cuts, so going from 5.1 to 4.1. So each rate cut is considered 0.25%. And then the market is expecting similar lines, 4 rate cuts in 2025, and then an additional 4 rate cuts in 2026. Obviously, these are just expectations. They've changed drastically. So if you go to the next page, this is just a zoom in of those expectations. So you'll see that gray highlight in the background. That's actually how drastically the expectations have swung throughout the last year. So at one point to start the year, we were expecting up to 7 rate cuts, the market was, and obviously that shifted significantly with inflation being a little stickier than expected. But the trend overall, again, by 2026, getting rates back down into that 3% range. And then lastly, two more pages, page 7. So now that inflation has broken through 3%, the target goal for the Fed is still to get down to 2, but certainly on trend to do that. The new focus has been labor markets and unemployment, and recent reports have swung the market pretty drastically over the past 2 weeks. We got a jobs report that July added significantly less jobs than expected, and a sharp decline from the jobs added in June. The next week, we got a follow up that the jobless claims number was lower than expected. So positive news that the labor market was a little stronger than the jobs report the previous week had indicated. And then unfortunately, we triggered what's called the SOM rule. And so to break it down as simply as possible, it's really just a trigger that shows the unemployment rate is accelerating faster than expected. And so it just shows the last 3 months on average. That average is now at least 0.5% higher than the lowest point over the past 12 months. So again, just a ramp up in unemployment. That was triggered with the July jobs report, and that rule has indicated or signaled the past 12 recessions. So just another kind of red flag in there that maybe a recession's on the horizon. But I'll caveat that with saying that the other red flag we've seen that's been a 100% predictor of recessions in the past is the inverted yield curve. And we've been in an inverted yield curve, so that means shorter term interest rates are higher than longer term interest rates. We've been in an inverted yield curve since July of 22 and have not fallen into a recession yet. So, the famous saying is it's different this time. That's yet to be determined. Obviously, only time can tell. But again, just another red flag that, the Fed is hoping to have a soft landing and avoid a recession, but just another indicator that we may see a recession on the horizon. And if we do, that would certainly trigger the Fed to be more aggressive in their rate cuts, and we'd see more rate cuts quicker. Despite that, we do continue to see strong consumer expenditures and growth. Company earnings continue to be strong. So again, that's why we haven't seen a recession yet and could postpone the recession even further. And then lastly, page 8, obviously big event coming on the horizon is the election in November. And so just to kind of put it into context, historically, it really hasn't mattered, especially post-election, what happens in terms of who wins and which party goes into the White House. If you look at the past 3 administrations, on average, 16% return for Obama and Trump, and then most recently the Biden administration through the end of June, about a 12.5% return on an annual basis. So very strong relative returns. The Bush administration is a little bit of an outlier, but consider we experienced both 9/11 and the great financial crisis in 2008 during his administration. So again, a little bit of an outlier there. What's interesting is you can see that depending on what party is in power, it really dictates the sentiment that individuals and consumers have towards economic conditions. When Republicans in power, no surprise, Republicans tend to think the economy is doing very well and Democrats not so much, and vice versa. I will say it does seem to appear that Democrats tend to be a little more pessimistic than Republicans anyway. But as of right now, you can see Republicans not very favorable on the economy with the Biden administration. Certainly, if Trump was reelected, I'm sure those sentiments would change drastically. So the good news is historically, the year after an election, and this goes back to the mid-40s, every presidential election, on average, the year following an election, markets are up roughly 10%. So things could certainly change. Obviously, the economy will impact that certainly. But on average, we see volatility going into election because of the uncertainty of who will win. And then once that election is finalized, that certainty comes back in, markets tend to trend higher afterwards. So our view is, continue to stay disciplined in your approach and your targets. Take our cues from the Fed in terms of when we need to start rebalancing out of cash and back into fixed income. When rates come down, those fixed income securities, so both the core bonds and high yields, will start to outperform. So we may see an opportunity in the near future to start rebalancing as that 5% yield on cash comes back down to 4% and 3%. back into fixed income, taking advantage of a very strong bull market for bonds. And then into our reports, you can actually just quickly flip over to page 4. So a fantastic quarter in terms of return. So for the total plan, quarter end June 30, 143,000 investment gains, good for a 1.4% return, and right in line with your strategic model. And that ranks you in the top 30th percentile of other public pension funds across the country. Led by your large cap index fund, the Vanguard Institutional, up over 4%. High yield bonds, 1.4%. And then your global infrastructure through Cohen & Steers, up 1.3%. Fiscal year to date, so the first 3 quarters of the fiscal year, $1.5 million in investment earnings, and good for a 16.3% return. Did slightly trail the strategic model, but still ranked in the top 18th percentile of other public pension funds. So outperforming 80% of your peers for the fiscal year to date. On a 1-year basis, so the past 12 months, earned 1.1 million or 11.7%. Did trail the strategic benchmark, but again, performed in the top 39th percentile, so outperformed over 60% of your peers. And to no surprise, led by your large cap allocation, up nearly 25%, mid cap 13.7%, and then your international manager, American Fund Euro Pacific, up 11.4%. On a 5-year basis, 3 million in investment gains, good for a 7% return annually. And then on a 10-year basis, 4.9 million in investment gains, good for a 6% return annually. And then page 11, again, just a lot of those numbers that I went over, but we did finish the quarter at 10,400,000 in total assets. As of yesterday, that has increased to just shy of 10,800,000, and that does not include updates from your private real estate manager or your global infrastructure through the end of July, because we get those statements quarterly and monthly. But again, very strong 4th quarter of your fiscal year. So hoping to retain that 16 to 17% return for the fiscal year, and continue to drop off a lot of those losses from 2022. So with that, no concerns on any of your funds and investments. Our only recommendation is just to continue to keep an eye on interest rates, and as they come down, may see an opportunity to start rebalancing some of that money back into your high yield and sawgrass with your core bond allocation to take advantage of the bond bull market that will happen as rates come down. So with that, I will conclude my report. I've talked quite a bit, so I'll open it up to you for any questions or anything you'd like to discuss.
Any questions?
No. Make a motion
Thank
to
you.
accept the report.
Motion passed unanimously. Thank you. All right. Move on to Klausner, Kaufman, Jensen, Levinson with Mrs. Parrish.
Yep. Hi, everybody. Can you hear me okay?
Yes, good morning.
Great. Good morning. I have nothing to report on my end, so all is good in the legal department. Just wanted to let you all know that our office will be at the Division of Retirement conference in November. So hope to see some of you there if you are available to attend. And I'm happy to answer any questions if there are any.
Good. All right. Thank you.
Thank you.
No motion for that. Okay, next to the Resource Center.
Included in your meeting packet are the upcoming conference listings. One is a new one that is given to us. It's close by. I do have a copy of the handout from the meeting if anyone's interested in looking at it. Also, I have the flyer for the 53rd Annual Police and Firefighters Conference, if anyone would like one of those agenda pamphlets. I have that available for you. The next item I have is the premium tax distribution. which the city has already received and the mayor has signed off on it. The sheet shows you last year for 2022, you received $71,357.19. This year, you received $68,407.65. The next two sheets come from our finance department, showing you some changes. These are unaudited, but for you to take a look at the contribution rates, different funds, sheet, real estate. And these go up till June also. You can see your net income, the different payouts that were done during the quarter. Any questions on this? That is all I have to share.
I know we've been talking about doing the workshop. Where do we stand on that? Are we just holding off for now?
The workshop we're going to do in December,
December, okay.
but we are going to try and have a meet and greet in September. I just got a few dates this morning. We'll be coming back for the general plan that is unable to quorum today, so we'll be coming back for that. But what we'd like to do is either here, maybe in the annex, having myself, Scott Bauer, and someone else from our office come up, just have some snacks, invite the retirees and the current employees so they can meet us and we can answer any questions anyone has. And we'll try and do that in September. As I said, I just got some dates this morning to see if the room is open, you all are available, and we'll send out an update on that. Then we'll be scheduling the workshop for the December meetings.
Thank you. We need that, we need to have a motion for that, or? Okay. All right, thank you. What are we doing here? Quarterly expenditures. All right, everybody review the quarterly expenditures.
The, excuse me, the line of December 23rd, P. Simons says refund.
I can talk to that. When the actuary went through and figured out the changes at the beginning of the year because the firefighter retirees got lower, they realized that when they did the actuary for him in prior years, there was a mistake. And so they refunded him that mistake.
Good.
I make motion to pay the bill.
He made a motion.
You made a
so-
motion. I'm sorry, I got caught up on.
No, you're fine. That's good.
Just taking a good look. Yeah, I second that motion.
All right, motion passed unanimously to accept the quarterly expenditures. Are there any public comments? All right. I'm adjourn the meeting. Thank you.
motion to adjourn?
I should.
Motion to adjourn.
Yeah, I second that motion. Sorry.
All right. Meeting adjourned. Thank you.
Thanks, everybody.
I can't. You gotta know.